Okay, so my name is Maier. I'm a CPA. I actually graduated from the U of A back in 2002 with a BCom, ran off, did a PhD, and then loved Edmonton so much in our winters, came back here, but got family, so I love teaching here. I became the associate dean about 19 months ago, and can't keep doing all the teaching that I was doing before, but I said I wanted to teach in the MBA program, continue doing that because I've enjoyed it. So I've taught the introductory financial accounting course that everyone takes in their first semester. I'm also going to be helping out with the bargaining and negotiations class. And this past term, the students selected financial statement analysis as one of their courses. So what we've done in that course is we kind of give you an idea of how to value securities, so we mainly focus on stocks. We do a simulation on a conference call between investors and management, or the analysts, put people in both roles. So it's been a really fun course. And then we also added in this part about behavioral finance, because so much of the decisions that you make in investments, there's a lot of mistakes made, and those shouldn't be happening in a lot of cases. So wanted to try and get people to understand a little bit better why they're making the decisions that they are. So I'm going to pass out some pieces of paper. I think everybody should have a pen here. So let's make this interesting. I've still got all this UK money. Okay, well, let's make this for 20 bucks. So whoever gets the closest will win 20 bucks here. So what I'm going to do is, on the paper that you've been given, I want you to carefully choose a number between 0 and 100. Now, before you pick the number, understand what the rules are going to be. So we're going to determine the winner. What we're going to do is we're going to add all the choices in the group. So Chris is going to collect all the papers while I'm presenting. He's going to add everything up, and he's going to total that, and then we're going to divide by the total number of submissions that we've got. So we're going to get the average in the room. Then what we're going to do is whoever is closest to 1/2 of that average is going to be the winner of the $20. Okay, everybody understands what the rules are? So make sure you put your name on the paper. And then you can put your number down. And once it's ready, I'll get Chris to run around and collect the papers for me, and then we'll see how that goes. So why are we going to do this? I'll show you in a little bit why we're going to be doing that, and we'll give you the results. The whole basis in behavioral finance and also behavioral economics comes out of this notion of market efficiency. Market efficiency started in the 1970s. A really smart guy by the name of Eugene Fama at the University of Chicago said, you know what, markets are always efficient, so whatever price you see, that is always accurate. Okay, now this has some implications, right? It's a pretty profound statement, because it means that no matter what you do, that price always has all of the information that's out there. So there's never a reason for you to go out and get more information. The reason for this is if you've got information that the price should be a little bit lower, what do? You're going to sell off a little bit. Now it should move the price down. Okay? If you think the price should be higher, what are you going to do? You're going to buy it, and that'll push the price up. So the price should always be efficient. So it's based on the assumption, number one, that investors are rational and that they always price things rationally. Okay? Now, to the extent that they recognize, okay, some people might not be fully rational, but those people that are too high, some people that are too low, they'll just on average, if they're normally distributed, they'll wipe each other out. And so everything on average won't affect the overall price that you observe. And finally, some people said, well, you know what, there might be some correlations here. So some people might make the same mistakes. So it might not just be randomly distributed. The argument for market efficiency says, well, if you've got a whole bunch of these mistakes being made in a common way, you should have people out there that are going to take advantage of those mistakes to make money. Okay, so if you realize the true price is here and the price is actually down here, you're going to buy it all up and that'll drive the price up. Okay, so those are kind of the three tenets there. Now, this has some implications for how you handle your investments, because if the market is fully efficient, then you cannot earn abnormal risk-adjusted returns. Okay, in other words, for whatever level of risk you take, you're going to get the market return that you should get related to that risk that you've taken. So the prices will then simply follow a random walk. Okay, what does this mean? Well, don't try and pick individual stocks, essentially. You're best off just buying an index fund and holding that market for forever. Okay? And if you looked early in the 1970s, there were a lot of people that were quite excited by this theory that came out, and they were testing it, and there were a lot of empirical observations that seemed to support this. Now, what happened in the 1980s? Well, there were a number of challenges that came out in the 1980s because all of a sudden you had a bunch of people saying, you know what, humans aren't always rational. We do a lot of really stupid things. Okay, so for example, if we asked you here, how many of you are an above average driver? I'm not going to ask you to raise your hands here. Okay, but if you follow the typical progression, most people will say that they are an above average driver. Okay, of course, nobody's going to say that they're below average, especially to your insurance company. So what's that going to do? Well, everybody thinks that they're above average, but that cannot be possible. So people just have a biased view of themselves. Also, when we're talking about investments, investors tend to trade on a lot of noise. So if you go to a cocktail party, you say, you know what, I've invested, my broker recommended this stock, it's really good. Okay, how much time do you actually spend testing out that company? Probably zero. You might go and buy it, and it always amazes me. People spend more time buying a car than they will do putting down $100,000 on a single investment oftentimes, okay, which can not usually have really bad effects. So there was this really smart guy named Fisher Black. He probably would have won the Nobel Prize if he hadn't died early. He had throat cancer, but he said, you know what, people tend to follow gurus. They don't diversify their portfolio properly. They tend to churn stocks, so they trade a lot more frequently than what they should. They tend to sell the stocks that have risen, that are winning, but then they hold on to their losers because they don't want to recognize the loss, even though they should, and they end up with subpar performance. There's also a lot of decision-making anomalies, and then you've got people that deviate from rational behavior. So you've got different attitudes towards risk. People just can't calculate Bayesian numbers. Don't worry about that if you don't understand that. That's something that you take in the EMBA. Basically means that when you get new information, you incorporate that new information into your decision making. Okay? People don't do that though, typically. And then there is sensitivity of decision making to the framing of problems. So if I give you a certain problem, how I pose the problem to you can actually impact the choice that you're going to make in solving that problem. Okay? And we're very sensitive to that. So this leads us to attitudes towards risk, and it brings us to prospect theory. So we actually spend a little bit more time in the class actually talking about this. But this was proposed by Kahneman and Tversky in 1979, and believe it or not, this paper is now the second most cited paper in the business literature. So it's a very important thing. And originally people just thought, this does not make sense. It's not something that we're going to do. They were actually psychologists rather than economists, which is why they took a big hit there. But the key to their theory is that investors behave differently when faced with losses versus gains. Okay? And there's a lot of violations of what normal economic theory would propose. So here's another experiment for you. Okay? You don't have to write this one down. Just think about your choice A and B. And if somebody's got a calculator here, I'll ask you to calculate these afterwards. So, choice A is you're going to have the option. I am going to give you $2,400, not real, okay, by the way here, but I'm going to give you $2,400 for sure, okay? Or option B is we'll have a little lottery, and there's a 33% chance that you'll get $2,500. There's a 66% chance that you're going to get $2,400, and a 1% chance that you get nothing. Okay? So which choice are you going to make? So let's see. How many are going to choose A? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. 11? Okay. No. Oh, good. And so 10 for A. And then how many are going to choose B? 1, 2, 3. We got some on the board. Okay, 5? Anyone over there? Nope. Okay. You have now a 33% chance of $2,500 or a 67% chance of $0. Or choice B, you can have a 34% chance of $2,400 or a 66% chance of $0. Okay, so how many choose A? 1, 2, 3, 4, 5, 6, 7. Okay, and how many choose B? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. We had a few people that didn't vote here. So. No one. Okay. So, how many of you switched your vote? Okay. Let's take a look at how this works. So, with experiment 1, what's the expected value? I think you were calculating. Yeah, so if you take 33% times 2,500, so it's 2409. So if you take this gamble is actually worth $2,409. Okay? But the majority of you chose option A. Why did you choose option A even though it's worth less? You like that certainty, okay? Even though you've actually got a pretty good chance of getting more than you had there, right? It's really only a very small probability that you're going to have anything less than 2,400. But just that small chance that you could lose some money pushes you towards wanting to choose option A. Experiment 2. What is the value of this now? So 33% of 2,500 is 875, and then here it's definitely less, right? Yeah. So you're getting less in option B. Now we had people that had chosen choice A. They liked the for sure thing in the first one, and then all of a sudden you flip down to this one here. Why did you do that?
Because the higher percentage.
The higher percentage,
Yeah.
Again. Yeah. So again, we focus on the likelihood of these outcomes. So this is the whole crux of Kahneman and Tversky's argument. And they took it even further. And what they did is they gave people a bunch of different gambles. Okay? So they said, okay, and they didn't actually pay out this much money, but they said, in theory, you have a choice, you have 80% probability of getting $4,000, or for sure you'll get $3,000. Okay? Which do you choose? Well, not surprisingly, a lot of people liked the sure thing, even though here you get $3,200 in that condition, right? Then what they did is they flipped it, and they said, okay, now what we're going to do is we're going to put a negative sign in front of everything, and we're going to ask you what is going to happen. And when they did that, now you've got more people choosing that they're going to lose $3,200 versus losing $3,000 for sure. So even in expectation, you're more likely to lose money. People would be more likely to choose that, even if there was a small probability that they could avoid the loss. Okay? So what Common Tversky did is they then came up with this little graph, and this is actually a pretty famous graph in the economics circles. What it does is it basically says that if you're in a region where you're facing a gain, you tend to be risk averse. Okay, you like the sure thing. Okay, so I'd rather, and that's what we saw with that experiment 1. Most people wanted that sure thing rather than taking a slight risk that they would get 0. Okay, the second part was if you get into a region where you're facing a potential loss, you actually become risk seeking. So now you'll take a gamble to avoid a painful loss. Okay? And you'll notice it's not symmetric here. So a very small loss is quite painful, whereas a slight gain makes you feel good, but it doesn't make you feel quite as good. So you can kind of think about that from everyday life. There's a lot of times where you get a small gain, you feel pretty good about it, but then if you have a loss, even if it's a small one, it's really painful, right? Think parking tickets, okay? That type of stuff, okay? So that's what they came up with. So there's a few applications here. One of the things in investing is that people tend to be investors are overconfident. So you get information, you place a lot more weight on that information, and you're really overconfident that you've made the right decision. So you're not as likely to change when you get new information. When it comes to accounting, kind of my area, there's this thing called accounting conservatism. And basically that means that we tend to recognize our losses faster than we recognize gains in accounting. Okay? Don't worry about that too much, but that's the way the accounting rules are set up. Why are they set up that way? Well, they're set up so that we avoid this problem of managers taking on excessive risk to avoid small losses, right? Then we've also got what we call earnings management. And earnings management shouldn't happen. If you do it, you're going to get slapped, in theory. But earnings management says we engage in certain financial transactions to meet earnings targets. Okay, so investors are expecting us to hit a certain number. You know what? Let's see, can we shift the sale from this period into this period? Okay, or you know what? Can we defer those expenses to next period? Let's not invest as much in R&D this period. So that also applies there, and then also investor sentiment. So I'll show you this little graph, and if anyone can spot the problem here, what this is these investigators, Burkstaller and Deshev, they took and they looked at the earnings interval, so how much the earnings per share for a bunch of different companies, and then they put them in bins. Okay, so if right around here is you would have an earnings per share of 0, and they kind of normalize this by stock price. Here would be you have a 5 cents per share earnings, and so on and so forth. Okay, does anyone notice a problem here? Right around 0, right? If you think of this as kind of economy-wide, it should be kind of a uniform, nice uniform, normal distribution. It's not. There is a big gap here right at 0. So what's happening? Well, managers are afraid to report losses. Think about if a company reports earnings where they've just lost a small amount, what happens to the stock price? It drops down quite a bit. Whereas if you beat by a couple pennies, not a whole lot of reaction, right? Okay, so again, this is where prospect theory is starting to come in. Managers want to avoid this. So we've got some evidence here that managers are just slightly shading the numbers just to beat their earnings targets. It's a pretty clever way of looking at it. All right. Now, so those are kind of the first two pillars that have been attacked there. The third pillar of the efficient market hypothesis basically says that even if investors are irrational in a systematic way, won't arbitrage make sure the market is efficient? Well, this relies a lot on this idea of common knowledge. So we did a little experiment with common knowledge here earlier. So Chris, you want to give us the results?
Sure thing. So we had 17 people. Okay. Total is 635. So divided by 2 gets us to the average is around 37. Divided by 2 is roughly 18.6.
Okay.
And we had Barry with 18. There's going to be our winner. So
Barry with 18? Okay. And there you are. Okay. Does anyone want to know what the economist would say that number should be? What should have been the number picked?
25.
0. Okay? Because what you have to do is you have to not only think about what choice you're going to make, you have to make a guess about how smart other people in the room are and what they think other people in the room are going to do. Okay? So at a maximum, let's say everybody chooses 100. What's your best choice? 50. But you're probably thinking, yeah, people in the room aren't that dumb to all pick 100, so 50 is probably a good starting point. But if I think everybody else in the room is going to pick 50, what do? And then I drop it down to 25. Right? Okay. Now here you're starting to get, okay, are people smart enough to choose a number below 25, or is that going to be kind of where they stop? Well, so at that stage, if you think everybody else knows that they're smart, what are they going to do? Now it goes down to 12.5, okay? Then down to 6.25, and you keep marching down until the rational choice should be 0 if everybody knows that everybody else in the room is really smart. So this is actually pretty much exactly what I was expecting. You usually get people that go about 2 or 3 steps down in their guesses. So thanks for participating in that. But it's just an example of how there are limitations to our rationality. Again, the efficient market hypothesis would say that everyone should have picked 0 in this room. But not everybody did. Okay, how many people picked 0, Chris?
nobody thinks it.
Okay, not a surprise. Believe it or not, after you've been in business school for about a year, we actually usually get about 4 or 5 people, because I usually do this one in the second year. I'll usually get about 4 or 5 people in a class of about 30 that might pick 0. So they do learn to be a little bit more rational there, but still, you don't often trust some of those things. So anyways, how am I doing on time? Am I still good? Okay. So I'll just talk a little bit. This is, I think, my final slide. So the final idea here is that shouldn't arbitrage take care of any of these mispricing in the market? Well, this assumes, again, 2 things, that there's rational investors in the market. And we've just done a little experiment that shows that maybe not everybody is rational. And then second, that there are no limits to arbitrage. Okay? What is the limit to arbitrage? Well, it basically means that you have an unlimited amount of money to either buy or sell securities so that you can push the price up to the price it's supposed to be at. So you're going to grab all those little pennies that are out there. If there's a penny to be made, you're going to grab it. Okay? Turns out that's very difficult. And there's this guy named Andre Schleifer, wrote a paper with Vishny back in 1997, shows that if there's any sort of cost that you have to arbitrage, there's going to be what we call limits to arbitrage. So arbitrage is expensive. You have to borrow money sometimes. You have to worry about that. People that have lent you money might decide to just pull the money in when things have been going down. Now, Andre's made a fair bit of money over time. He actually runs a hedge fund and owns one or two castles in Europe. So he's used this theory to invest very successfully, but he takes advantage of kind of these areas where there might be arbitrage opportunities where people haven't fully exploited that. So good news is if you're an investor, there is a reason to go out and do a little bit of investigation because the market isn't always perfectly efficient in that sense. So you can beat the index occasionally. Again, don't recommend that most people do it right off the bat. It does take a lot of experience and you do have to get into it, but overall there are opportunities out there. So with that, thank you very much. Okay.